The startup world brings with it a whole new vocabulary of terms and jargons that startup owners need to be familiar with. If you are planning to raise capital, you would have probably heard the terms pre-money and post-money valuation. As a startup founder, these are very important in investor negotiations, so you should understand what they mean and how they impact the financing of your company. My name is Sai Kishore, and in this video, we are going to look at two of the most commonly used jargons in the startup world, pre-money and post-money valuation. Let's start with a story. Bob and Steve are friends from college. After quitting their high-paying jobs, they set out on a journey to form their own startup. Bob is a techie who has experience in coding and building products, while Steve is a management graduate and has experience in managing his father's business in his younger days. They come up with a great idea which they believe is market-worthy. In March 2020, Bob and Steve officially formed their own company and set it up as a C Corp. Bob and Steve have put in their savings of $20,000 each and start building their product. As co-founders, they now own 50% in their company. And in exchange for their investment, they get 20,000 shares of stock worth $1 each. They decide to take a small office and hire a team. And 6 months later, they release the first version of their app. They also start getting their first paying customers and start making revenue. But the problem is, they've run out of money to market the app and spend on further development. So like any other startup, Bob and Steve plan to raise their first round of capital. They plan to raise $200,000 from angel investors. But this brings another problem. How much stake should they give to angel investors in exchange for the $200,000? Enter the game of startup valuation. Let's take a step back and look at how things started. The story started in March 2020 when Bob and Steve formed the company. Each of them had invested $20,000 in the company and in exchange got 20,000 shares of $1 each. At this stage, the value per share of stock was $1 because there was pretty much nothing in the company other than the cash that was invested by Bob and Steve. Fast forward 6 months, the company has gained quite some traction. By September 2020, the company completed its app, hired a small team, and also got its first paying customers. So the company is definitely worth something because of this early traction. When Bob and Steve approach angel investors, this early traction is given a value. Let's assume that the value of this early traction is $1 million. This valuation is called pre-money valuation. Pre-money valuation refers to the value of the company before external funding. So the 40,000 shares of stock owned by Bob and Steve are now worth $1 million. This means that each share of stock which was worth $1 when the company started is now worth $25 per share. How do we get that? We divide the pre-money valuation by the number of shares issued as on that date. Since Bob and Steve bought 40,000 shares when they started the company, we divide the $1 million by 40,000 shares to get $25 per share. One question that you might ask is how did investors come up with that $1 million pre-money valuation? Well, there are several ways in which early stage startups are valued. Some of the most common methods are the Berkus method, the future valuation method, the risk summation method, the market multiple method, and so on. We'll keep the discussion of these methods in a separate video. For now, what we need to understand is that the pre-money valuation is the value assigned to the company before the investment money comes in. So what is the post-money valuation? The answer is pretty simple. Post-money valuation is the sum of pre-money valuation plus the money raised in that round. In our example, Bob and Steve are planning to raise $200,000 from investors. So the post-money valuation of the company would be pre-money of $1 million plus the capital raised of $200,000. That would give us a post-money valuation of $1.2 million. Let's see how this impacts the cap table. When the company started, Bob and Steve each invested $20,000 and got 20,000 shares of $1 each. So there were a total of 40,000 shares that were issued. Bob and Steve therefore own 50% stake each in the company. When the investors came in, they valued the company at $1 million, that is, at $25 per share. So when the investors put in $200,000 at $25 per share, they would get 8,000 shares for the money invested. Putting this back into the cap table, Bob and Steve continue to own the 20,000 shares each. The investors now get 8,000 shares, and that gives us a total of 48,000 shares in issue. Therefore, the investors roughly get about 16.7% stake in the company, and Bob's and Steve's ownership is reduced to 41.6% each. This reduction in the existing ownership when additional capital is raised is called dilution. In this example, Bob and Steve's holdings got diluted from 50% each to 41.6% as a result of raising capital. Let's now summarize what we've learned so far. There are several ways in which startups are valued. Pre-money valuation refers to the value of a company before the external funding comes in. Post-money valuation refers to the value of the company after the external funding comes in. Whenever external funding is raised, the existing shareholders forego a percentage of their shareholding. This, in the world of venture capital, is called dilution. Thanks for seeing this video. I look forward to answering your questions in the comment section, and I'll see you in the next video.